Good morning, everybody. Thank you for coming to the meeting. We're running slightly late due to a bit of a technical hitch-up on the sound, but I think we're all ready to go now, so we'll make a start. Firstly, are there any apologies?
We've had apologies from Councillor Peter Wharf.
I'd also like to point out at this time that Jim McManus is, after many years of loyal service to the council, is miraculously choosing to retire. So congratulations, Jim. I'm sure we have his entire best wishes for you in whatever you decide to do afterwards. Well done. Thank you very much. Minutes of the meeting on the 14th of June and our extra meeting on the 9th of November. Is everybody happy with those, or does anyone want to point out any queries or factual issues? No? In which case, we'll sign those as an accurate record. Thank you very much. Declarations of interest. Are there any declarations of interest that you need to declare today? No? Okay, thank you very much again. Public participation. I believe we don't have anything today.
No, that's right, Chairman.
And no questions from councillors either, or urgent items?
That's correct.
Okay. In which case, we'll go then straight on to item 7, the external audit update from Ian House of Deloitte. Over to you, Ian.
Good morning, committee. Thank you, Chair. Just an update in terms of the external audits of both 2021 pension fund accounts and 21-22. As the committee is aware, both are delayed. The 2021 audit is substantially complete now. I have no concerns in terms of the statements that were prepared for audit. There is one stale price adjustment that we've identified whereby when you produce the accounts, you're obviously taking the latest available market information on pricing. When we come to do the audit, there's more recent information available. So it's not really an error, it's just an adjustment of the latest information available. So we will report that to you when we eventually report on the 2021 accounts, but at this point in time, there's no reason to believe we would give anything other than an unqualified opinion on those accounts. 21-22, that audit is well progressed as well. As the committee will be aware, the situation is that we give an opinion on the council accounts, which then includes as an appendix the pension fund account. So the delay in signing off the pension fund accounts is very much linked to the delay in signing off the council accounts. And the council accounts for 2021 are delayed due to an infrastructure issue which has arisen nationally in terms of how infrastructure assets are valued and the information produced in the accounts in relation to those. A statutory instrument is expected to be laid before Parliament before Christmas, which will clarify the accounting for those infrastructure assets in the council accounts. Once that is done, we can do the final bits to clear that up, and that should allow us to sign off both the council accounts and the pension fund accounts for 2021 in January 23. And then we'll move on to the audit of the 21-22 council accounts, which we've recently received. And then once we've done that, we'll be able to complete the pension fund accounts. So my apologies to the committee in terms of the delays. These are national issues. There are delays across the country in terms of signing things off. But we are aiming to bring that back into normal timeframes as quickly as we can.
Thank you very much for that. Any questions? I think, as has been made clear, members have been very concerned in the past about the delays involved. And it is good news to hear that we're on a path to get things back to normal a bit. But how confident are you that this will actually solve the issue?
I suspect it will take most of 2023 to get back on track. It'll probably be the very end of 23, early 24 before the 22-23 accounts are back online. That is actually our final year of contract for both the council and the pension fund audit. We chose not to re-tender for the contracts for local government, and therefore you will have a new auditor come in for 23-24, and obviously that as quickly as we can finish, then they can start and bring things back into a normal time frame. But it is a very challenging market at the moment in terms of the skills available to do the work, the number of people with the expertise on local government accounting particularly, and I think the system will continue to have challenges for some time. The FRC have appointed a new sort of person into that's the Financial Reporting Council, appointed somebody new to be in charge of looking at the system as a whole and the training that's available for people with the expertise to do this work, the fee rates for this work and all sorts of things to try and create a more sustainable market for local government audit work, which will include the pension funds.
Just to clarify that, are you saying that Deloitte is withdrawing completely from local government auditing or just from our contract?
Yes, good question. No, from local government auditing for the next period of the contract, we remain committed to the public sector. We just don't think the local government audit market is allowing us to deliver the quality that we want with the resources available at this point in time. There are a number of changes needed to the system, including the requirements to be a key audit partner, which we think need to be reformed before we'd be in a position. But we would like to come back into the market. We're committed to public sector audit and playing our role in assuring the public in terms of how their money is being spent. But we're just not in a position to tender for the new contract that will come in. We didn't think it was appropriate at this point in time.
Councillor Beasley, I believe you've got a question.
Thank you very much indeed, Chairman, and apologies for being online rather than being present in the room. My questions to Mr House relate to my separate role as Chairman of Audit and Governance of BCP Council. And obviously my questions are therefore nothing to do directly with Dorset Council's audit, although the audit for the pension fund has had a material effect on the timing of Grant Thornton's work for BCP Council. And Mr House is aware of all of this, and we have met separately, including with Aidan Dunn, your Section 151 officer, previously. My question, I think, is about what Mr House has said. Firstly, are all of those updates being conveyed directly to Grant Thornton on behalf of BCP Council? And is there anything material within there that I should be aware of in my other role relating to the audit both for 2021 and to 2022 in terms of the timing and any further delays which may not have surfaced yet?
Thank you, Councillor Beasley. Good to see you again. Fair question. So, as we agreed with you, we responded to Grant Thornton's what's called an IAS 19 letter, where we give assurance on the work that we've done to them. Just a couple of days after I sent that letter to them, they requested the letter in a completely different format and a revision of the letter. We're working through that, and they should receive that this week. Apparently that was in response to regulatory challenge across Grant Thornton's portfolio, so they've asked for it in a different format. We've now done that extra work, and we'll provide that to them this week. But we did meet the timeline we agreed with you when we met last time. There is nothing, as far as I'm aware of, that should impact, but they obviously need to make their own conclusions in terms of the information we provide them in relation to our findings on the audit. But as I said, the only issue we found on the 2021 audit is a stale pricing adjustment, which is not material. It's less than our materiality level. We haven't completed the 21-22 audit. It's substantially underway, and most of the work has been done, and nothing has come to light yet that I'm aware of that I would be worried about. But obviously they will need to wait until we've completed that work and provided the IAS 19 assurance before they can give their opinion.
Through you, Chairman, can I thank Mr House for that update? Could I ask you, Mr House, if you could perhaps keep in touch, not just with Grant Thornton, but with me as, if you like, an intermediary through the audit and governance process, so that I'm aware at every stage, should there be any other changes with relation to the audit on the pension fund, please?
Yes, Councillor Beasley, I'm more than happy to give you a regular update in terms of progress. If that's helpful, then I'm more than happy to do that.
Are there any other questions from anybody in the room or online? No? No? Okay, in which case, thank you very much for that update, and glad to hear that some progress has been made. I think, as I said, we have all been very frustrated by the delays that have occurred so far, and while we recognise that there's a huge, it's mostly down to national factors, we want to try and do the best that we can, obviously, to get this mitigated as quickly as possible. So thank you very much. Moving then on to item 8, the Brunel Pension Partnership update. David Vickers and Tim Dixon as well, I believe. Over to you.
I understand I have up to 11 o'clock, so I will definitely leave plenty of time for questions and answers. I've read the report that came from David and written by Steve, so I'll address some of the comments there. But I'll start, as always, if that works for you, with a brief update as to the macroeconomic backdrop, what's driven returns, what's likely to drive them going forward, and then a wrap-up of where we are, and then go to specific funds and focus on the ones you'd like me to. So please do jump in at any stage. I think when I think about the start to the year, and obviously it's epitomised really by what's happened in Ukraine and Russia and inflation. The Ukrainian situation, however, was just the spark that let the inflation rampant through, and it has had some very, as you're aware, from just going to the petrol pump, some very specific issues around Europe and around the UK. So we would have talked about this before, but if I just put it into perspective, if I think about quarter one, so the first 3 months of the year when the Ukrainian crisis was really coming up to the fore, energy prices were up aggressively, which meant that stock prices in energy sectors were up about 50% in relative terms. So the broad equity index was down and energy prices were up 50%. In quarter two, that moderated, and energy prices were up on a relative basis about 16-17%. And in quarter three, it's moderated even further, and energy prices were up 6% in relative terms. So still the best performing sector, but a moderation, which is what you'd expect. Because in order for energy prices to continue to do what they have done, you would have needed another doubling of the oil price. And as you're probably aware, gasoline prices, whilst it doesn't feel like it, actually have been coming down. So the headwinds that were faced in quarter one and arguably quarter two were very much more moderated in quarter three, which, as David will know, in other forums we've discussed two things. Firstly, the macroeconomic trends can persist, but the pricing ones probably won't, because I say for inflation to continue to double, you need all of those things to go up and up ad infinitum. And the other really significant point to note is that the market, the equity market and the financial markets at some stage begin to price the reality we have today. So if I think back to 12 months ago, the world was a very benign place, relatively speaking. Fast forward 12 months and we have inflation hitting 10%, oil prices that actually hit 130 and gasoline prices that were up some 400% from the bottom. This is a world we know that we inhabit. As such, the potential for unexpected surprises to continue is much, much lessened. And so as we went through Q1 and Q2, we counselled yourselves and partners that actually markets were beginning to get ahead of this trend. And as you go further into 2022, it became much more about the stock specifics you own, as opposed to whether you had energy or banks or what is called value exposure, or whether you had growth exposure, which had hitherto sold off quite aggressively. And as you're probably aware, the responsible investment policy, well, let me just stop there actually. The responsible investment policy we have, I just want to make this very clear, isn't about doing good. It's about fiduciary responsibility. It's about taking account of the single biggest risk we know in financial markets. Now, clearly there's lots we don't know, but it's why the government is asking you to, in your TCFD reports, to think about climate change scenario modelling. It's why it's asking corporations to report metrics around its carbon use and around its carbon footprint. These are very known risks, and one only has to look around, and obviously there's been a very sad incident quite recently with mudslides. The changing weather pattern and the financial ramifications are very certain. There isn't a world that exists in which these risks are going to moderate. They're likely to continue to increase even if we get climate change under control. It's why the Bank of England is making everyone stress test their portfolios for these very, very known risks. So it is, just to reiterate, a financial imperative to have a policy and to have a thought process around responsible investing. Now, it happens to also be, I would suspect, the right thing to do, but that is not why us or any of our managers or even yourselves are doing this. It's to protect portfolios. So as we look forward, it has been a headwind to the portfolio in Q1 and Q2 after about a 2-decade tailwind. So for a very long period, with oil prices even just bumping around at a stable level, energy prices, banks and material stocks have come under significant pressure since the end of the global financial crisis and before. But if you've just employed a sustainable equity fund, you may have run smack bang into the end of that current trend. What I'm trying to suggest is I think those trends, what we've seen in Q1 and Q2 is the unwinding of a 20-year fair wind for these type of strategies, and I think it's unwound almost fully now. We have had such a stark reversal in fortunes of energy stocks versus growth stocks, for example, that I think now it is much more about the type of stock you own and how it weathers the recession going forward, because inflation and higher energy prices are now a very known factor in the market. The other thing to note, I think, as Steve points out in his reports, that arguably, and I would say arguably in inverted commas, the world we now inhabit meant that some of the growth stocks that were owned are more or were more expensive. They weren't necessarily expensive in a world in which we had zero inflation and zero interest rates. But fast forward to that shock and surprise through the Ukrainian crisis and inflation at 10%, they would appear to have been more expensive. As such, they have derated. So the earnings, and this is very important, I think, the earnings of the stocks we own remain intact. Fundamentally, these are good, sound businesses. We do not own the type of things that one would have been horrified to find during the global financial crisis, i.e. cashless, profitless stocks. These are all solid. I mean, Amazon is not going. Sadly, I cannot see a world where I'm not answering the door twice a day to the Amazon parcel driver. These stocks are not disappearing. They are significantly cash generative, profitable businesses. All that has happened is they have been derated in a world where interest rates are now 4 or 5% predicted as opposed to 0 last year. And I think that's very, very important to note. The other thing that's important to note, and it's the RI policy that we share, lends all of the portfolios, largely speaking, towards a growth and quality bias. Now, growth stocks actually typically do quite well during periods of inflation, not the inflection point, but afterwards, because growth stocks typically allow other companies to weather the storm. And certainly if you think about however you define a quality stock would be typically one with a good balance sheet, with robust earnings, with stability and low volatility of cash flows. Again, those type of stocks would typically fare quite well over the entirety of the cycle, but certainly going into the environment we find ourselves in, which is, I think I can, without too much fanfare, say that I think recession is probably a locked-in event for next year. The conversation and the question marks just remain how deep that recession may or may not be, both in the UK, but also much more globally as the world starts to slow down because of interest rates are increasing. So that's the backdrop. If I then think about your portfolios after a couple of quarters in which those headwinds were unsurmountable, we move into Q3, in which actually, when I look through at least the active equity range, and we'll take those first if you'd like to, it was a mixed bag, but all of them were either just beneath the line or just over the line. So if I think about UK equities, in the first instance, it was up 0.3% against the benchmark. If I think about global high alpha, it was down 0.3 against the benchmark. The small cap fund was largely flat. The sustainable equity fund was up 0.4% against the benchmark. And EM, which is a slightly separate issue, which we can perhaps take in Q&A, was down 1.1 against the benchmark. So a much more measured return in what was a more fundamental quarter. So much less about interest rates and inflation. Obviously, there was some fun and games with the Conservative government at the end of the quarter, which definitely, for those last 2 days, did throw a bit of a spanner in the works, with sterling falling precipitously to 103. That was the lowest point. It's now back, as you're probably aware, at 120. And obviously government bonds, which you'll be aware of, falling precipitously as well. So that did have the effect of not creating mispricing in the market, but creating panic selling. As you've probably read, a number of pension funds had to quickly go into the market and sell whatever they could get their hands on in order to meet their collateral calls from the leveraged LDI portfolios. That did cause a 2-day, or even the week after that, a degree of mispricing, which is now zeroed out and started to move on as we move into the new quarter. I'll perhaps just pause there and ask if there are any questions, or ask if there are any particular funds you'd like me to step into first of all in more detail.
Steve, do you have any particular questions you want to ask?
So I'm going to make a few comments at this point. David, can you hear me?
I can, thank you.
Yeah, can, good. Actually, first of all, congratulations on improving the client report. I think this is the first quarterly client report we've seen in this format, and it's beginning to meet the standards that we expect from investment managers, and so well done on that. Some of the contents aren't so pretty reading, but we'll come on to that in a second. So I guess, this is right to the nub of the issue in terms of you've been talking about. I agree with all your kind of macro points about the economy and so on, and I'll touch on that later when I give my little spiel. But obviously, performance is the main concern. You've highlighted there that performance is essentially at either side of neutral in Q3, which is better. But when we look at the performance statistics on page 11 of the report, the performance is undoubtedly poor. Of the funds in the listed funds on page 11, there's not one that has met its outperformance target since inception, and all but the Global High Alpha Fund have lagged the benchmark since inception, and Global High Alpha, of course, only because it got off to a flyer. The fact that it got off to a flyer is a good thing, but that's the only reason that's been a bit of a rocky ride, very strongly outperforming and very strongly underperforming. So, it's kind of I touch on it in my report, and you've brought up the issue of this: does a conflict exist between responsible investing and fiduciary responsibility? And we are responsible investors. We want you to invest responsibly. We're committed to that decarbonisation strategy. But at the same time, what I personally want a little bit of reassurance about is whether I don't think it's. I mean, you didn't say it was just about the energy stocks, but you started by talking about the energy stocks. You then broadened it out to talk about the quality growth bias of the portfolio. But at the end of the day, my gut feeling is that maybe a little bit of valuation discipline has been lost by Brunel in the process of appointing managers a couple of years ago. Not enough attention was paid to that factor, and that's. Value is a recognised long-term factor, somewhat episodic, but it's a recognised factor in the market. I know it is a weight in what you do, but I think we need a bit of reassurance that that the type of responsible investing that Brunel is doing is smart responsible investing. It's not just going for the things that tick all the ESG boxes, that are doing the right thing, but yet are very expensive stocks. So I think that's the kind of, to me, is the kind of one of the crux of the issues. It's that the RI investing that you do will be smart RI investing, RI 2.0 versus RI 2.1, let's call it that.
Yep, sure. Let me embrace that very head on in the fashion that I try, which is very direct and to the point. So categorically, and this is a belief statement, I obviously can't predict the future, but this is a very strong belief statement that categorically I do not think there is a long-term trade-off between responsible investing and financial performance. What I think we have seen, and you're right, so lots of the portfolios since inception are down relative to the benchmark. As you'll be aware, Steve, lots of the funds were only launched 8 months to 12 months ago. And so we've run smack bang. And actually, if I'd have been having this meeting this time last year, all of the funds were above benchmark, every single one. So all of the damage, if one wants to call it that and be upfront, was caused in Q1 and Q2 when we had this huge rally in commodity prices. And as you rightly say, what one wants to be, you have a responsible investment policy, you want us to act in a certain way and decarbonize the portfolio over time. It does typically lend you to be underweight, as you can imagine, those sectors. So some of that is unavoidable. Do I think that is something that cannot be unwound? No, I don't. And I think Global Health is a very good example of that. So something that has a slightly longer time horizon over 3 years. You're right, it did get off to a flyer, but that's to the manager's credit. The fact it's had a weaker period, what is successful about that fund is the asymmetry. So it caught some of the good times, more of the good times when there were good times to be had, and has mitigated some of the drawdowns when they've been there to be had, leaving us still 150 basis points after fee every year up, which I think is a very creditable result in this type of market and leads us to be first quartile, very top of first quartile across all active funds. So I think the potential to continue to outperform as we had prior to Q1 and Q2 exists. It's obviously a potential. I can't sit here and suggest it's definitely going to happen, but the playing field has been leveled by the market getting more comfortable with the new world we live in. I think the other thing to say, what I can say with relative degree of certainty, and this goes to perhaps the energy prices in more detail, is that what has driven energy prices up wasn't that they were undervalued. It's that the energy price rallied from negative $40 during COVID to $140 during the peak of the Russian crisis. You need that type of commodity price and material price appreciation to drive these stocks forward. What they are staring down the barrel of, which is obviously a fairly known outcome, is a number of things. At the end of the day, we will have stranded assets, 100%. You know, the world is transitioning away. We know this. That train has left the station. That said, the timing around that is very, very uncertain, as we know. What you're also looking at with a majority of energy stocks is a potential litigation around the type of externalities that those companies have produced, and we're seeing that going through the Dutch courts again. You've seen it in most of the courts last year, and in the very short term, we're seeing what we've just seen announced by the government, which is a windfall tax scheme. So, as you're probably aware, energy companies in the round, this is in the round. There are some that don't. There are some that do. Certainly are getting in the UK taxed an additional 35% on any profitability. So these are very known things. So in order for those stocks to continue to outperform, they do need energy price appreciation, which, as you can imagine, is a difficult thing to predict away from just predicting the normal fundamentals of the company. When I think about the valuation discipline, it wouldn't really be, I mean, if I just rephrase the question slightly differently, I don't think Brunel has lost any valuation discipline because it's not something we outsource. So I guess the question is, have our managers been ill-disciplined in thinking about the valuation of the world? And my answer is, broadly speaking, no. There are certain instances, but across the piece, no. It is very difficult for us, as it stood historically, for us to pick up that value premium that you talked about, because the value premium was banks, energy, and material stocks, all of which don't necessarily lend themselves in any great shape or form to a responsible investment policy. But then on the other side, when I think about the stocks that have done well or not done well, it isn't all about technology and growth. When I think about our sustainable portfolio, actually what you look at when you see our weighted average carbon intensity is that it has jumped up. And it's because we have invested in a number of what I would call old industrial names that have credible paths to transition. So whilst there is a growth and quality bias, we have chemical companies. We're not in the rah-rah end of the market, which is basing itself on technologies that don't yet exist or hope over substance. We're very much, certainly in the sustainable equity fund, very much caught up in that old industrial sector where we believe that there is a credible path to transition, and indeed the stocks we own are there for the broader good. And chemicals companies are probably a good indication of this. On the face of it, they're horrible, very highly carbon intensive, but they have credible paths to transition and commitments to do so. But the products that they produce allow many, many others to begin their transition journey. They're what I would call a contingent stock. So actually, I think it's a bit of a misnomer to suggest that we're at the kind of upper echelons of growth and evaluation mismatch. But I think, to be fair, there will be instances of that case, because fund managers, are prone to get things wrong as well as right. When I think about growth stocks more broadly, however, and this I'm going to quote Bailey Gifford, so it's not my own view per se, but I do have sympathy with it, which Bailey Gifford probably epitomised the type of people you're talking about, I suspect, in your comments. When you look at the academic evidence, something like since 1930, only 1,339 stocks have actually contributed to wealth creation. By and large, they have all been growth stocks. They have three things in common, actually: rapid growth, which is one thing; strong cash flow, which is a security blanket around it; increased research and development, and the fourth thing actually is high volatility periods. And I'm cherry picking here, but I think about Amazon as the best example. Since 1997, when it listed, it's had 3 periods of drawdowns in excess of 50%. One of them was 93%. And yet, single-handedly, it's been the best performing stock, creating over $865 billion for shareholders. High growth stocks do come with high volatility. If you have a stock that's deemed its earnings might grow 50%, its starting valuation is much less relevant academically and empirically. But to your point, it doesn't mean they have to pick the right stocks. Valuation for me matters where you're wrong, not where you're right, if that makes sense. So your valuations provide a cushion for safety. And what I've done this year, as I've got familiar with the portfolios over the last number of years I've been here, last 18 months or so, is sit down with all of the managers, run through the positions they own, like when I used to be an analyst and a portfolio manager myself, and looked at the earnings profile. And what has reassured me that the valuations in this instance are a derating phenomenon rather than a fundamental problem is the earnings quality is still intact. The cash flows are still very strong. Most of these businesses have quite strong moats, i.e. defensive characteristics and propositions that can't be easily assimilated or taken over. So whilst it's not nice to say that you've seen deratings in growth stocks, I think the deratings have been driven by the environment we find ourselves in, which is that interest rates today are 5%, and 12 months ago, as I said, they were 0%. In a 0% world, the stocks were reasonably fairly valued. They were getting expensive, but the whole market was getting expensive, quite honestly. So we were pushed away from the valuation, the cheaper valuation of stocks, because we have a responsible investment policy, and slightly higher up into the spectrum because of some of the managers we've employed, we're more in growth and quality stocks. But I think we've got to a point now where, looking forward, most of that derating, as much as I'm able to say that with conviction, has moved on. And so I do believe the chance for continued outperformance, the likes we had prior to Q1 and Q2, is there, and catch up is quite easily had. It's because we have very high active share portfolios that I think that potential to rebound is inexistent. If I think about some of our managers year to date, or certainly since the end of the quarter, and I think about the poster childs of what you're talking about, the Bailey Giffords, they're up something like 12% in relative terms since the turn. Genesis is up 600 basis points since the end of the month. There exists the potential to significantly recoup those losses. Doesn't mean they're going to, but that potential exists for them. And some of those headwinds that we've seen, which are higher energy prices, cheaper stocks at that level, have all re-rated upwards as growth stocks have derated down. So the modicum of difference is now much more marginal, and it would require another output of a Ukrainian crisis, such that we've had to see energy prices go higher, commodity prices go higher, and inflation to indeed go much, much further for the weaker performance we've seen to continue to persist. And I think that probably has to be a lower probability standing here today than it certainly was at the beginning of the year, when it was a twinkle in everyone's eye that inflation was going to be in excess of 10%.
Yeah, I'll ask another question. Thank you, David. I asked a long question, so I suppose I deserved a long answer. I suppose maybe I'll ask a shorter question and we'll get a shorter answer. I find myself thinking about, you talked about the recouping the lost performance that we've seen. I find myself wondering whether it will be fully recouped, or whether, in my expectation, it will be partly recouped, and we might have the burden of the 2021, early 2022 performance hanging around our 3 and 5 year statistics for the next, few years.
I mean, it's banked. It's that loss, as it were. So it's definitely going to be in your 3 year numbers. We can't erase it. It is there. Can they recoup? Of course. I think that's the first thing to say. To be slightly frank, it depends on when you join certain franchises. As you said, if you've been in Global However from the beginning, you recouped it on the way up, and so actually the drawdown was nowhere near as big as the way up, and so actually you end up ahead of time. So that, if I use that as a test case for can portfolios withstand the type of drawdown we've seen? The answer is obviously unequivocally yes, using that as a prime example. If one joined the Sustainable Equity Fund at the back end of last year, for example, all you've seen is this drawdown. So depending on when you entered some of these franchises will depend on your burn-off period. For example, did you manage to capture some of the up before the good times stopped? Much like, as you know, we have a low volatility portfolio, which I don't think is owned by Dorset, but is a counterbalance to some of these growth portfolios. And so actually that has done extraordinarily well, as the growth stocks have done extraordinarily badly. At the minute, that low volatility fund is selling off because the growth stocks are doing quite well. And so there's a portfolio balancing exercise here to think about as well, which is one does have lots of eggs in one's basket, because I think sustainability became a bit of a, in the right way, but driven by net zero pushes and commitments and government intervention, etc., meant that depending on your entrance to some of these trends, it depends on how your performance will look on a modicum basis. But over 5 years, it's still going to be in the numbers. Can the performance be burnt off in 5 years? Yes, I think it can. Arguably, it took a quarter to unravel. So if I think about what must go up, must come down, you could almost get a quarter's reversal, although I think that probably is a little too optimistic.
Thank you, Darren. Anything else you want to add? One thing I'd like to follow on from, which is very much related to what you're saying, one of the eternal debates of fund management has always been active versus passive.
Yes.
I suppose what you're saying is that the active portfolios have done particularly poorly over the last 12 months, but now is not the time to be ditching them. So if when we come to look at our overall strategy, you for example, would be of opinion, presumably, that we shouldn't be looking to increase our passive exposure as opposed to our active exposure.
I think, yes, it's interesting. So in a previous life, where I was an active fund manager, I obviously had a dog in that race, so to speak. At Brunel, we offer traditional passive, as you know, just market bench weighted. We then offer climate adjusted or climate aligned passive solutions and active. I am relatively agnostic if I don't look at performance. In terms of, to your question, where I think perhaps some upside lies, it has to be, I think, with active, if I believe that the managers we've chosen will outperform in the longer term. If they were significantly above benchmark, I think that conversation would be a little bit more muted, because nothing goes up in a straight line. You do have these periods of weakness and strength with active managers. And I'm not allowed to give advice for very obvious reasons, but the statement I would make is, from where we sit today, I think the active managers we have are due, for no other reason than because of the drawdowns that have incurred, to have a period of strong performance. And so I wouldn't suggest that would be an equitable time to make that decision. If we were then significantly ahead of benchmark, I think that's a very different conversation to have. And I am relatively agnostic. I do think that you can fulfill your fiduciary and your net zero kind of pledges, if you like, with the Paris-aligned passive benchmarks, but one must remember they are also active in of themselves. The benchmark is active, not the stocks underneath, and so a slightly different term and terminology, but certainly worth remembering.
May I respond on that as well? Because I think that's a really fundamental, interesting question. Active versus passive. So I'm not agnostic about active versus passive. The vast majority of historical evidence over the past 10 years, 20 years, 50 years is that passive investing is a safer way to invest than active investing. Unfortunately, things have got a lot more complicated because of, as we go down the responsible investing track, because Brunel have come up with a couple of passive portfolios that enable us to invest responsibly, passively. But it is easier to to implement responsible investing if you have active managers. So that has complicated the picture, unfortunately. But I think this is a subject that we should return to when we come to reviewing things strategically. I think we should touch on that when we do training next time, and also when we come to the strategic review. I think because that's a really good fundamental question. Yeah.
And it's certainly certain active styles certainly asset classes lend themselves much more to active than to passive. So small cap, for example, the potential is higher. US large cap, if I'm asked for an opinion, I would say much less likely. to be able to outperform. But you're absolutely right. When you start putting a third dimension, risk, return, and outcome to your portfolios, actually it does lend itself more to active than passive. The only thing I would say, all of the kind of studies that have been undertaken, typically are quoting fees at retail levels, so 100 basis points, as you're probably very aware. The average fee we look at in your portfolio would be closer to 20 basis points rather than the 100 basis points. But it's a conversation that's well worth having, because philosophically it's Marmite to certain people, and so actually it's very interesting to align your principles and your philosophy to your beliefs and then invest accordingly. I'd say that's a very strong way forward in your next trading day.
Yes, thank you. Steve, do you have any questions or anybody else? Do you want to give you a few more?
What's going on in your emerging market fund, please? It seems to be suffering a little bit in performance.
It is, yeah. So this is the one where it's a 3-manager structure, as you know. It's Genesis, Wellington, and Invesco. It's the same themes essentially, but there is a wrinkle here which I meant to touch on, and I'll do so now. So when I look at the underperformance and we look at the 3 main drivers, they are 3 drivers are 88% of the underperformance when you look at it statistically. The one is obviously energy. Being underweight energy, and energy is a big part of the emerging market franchise, much higher than it is in developed markets, has been costly. The second one is if you are underweight, or as we are, you don't own anything in Saudi Arabia or Kuwait, again, that has been a costly decision. Saudi is now 5% of the benchmark. That isn't the same thing as saying that we're avoiding their oil stocks. We're not. The whole Saudi Arabian and Kuwaiti stock market is tied to oil. Obviously, as you're probably aware, there are huge subsidies that go to the population. So as oil goes up, those stocks that are consumer in nature also go up. This is less about the E in ESG and perhaps a bit more about the S and the G. And, it's obviously all over the headlines with given where the World Cup is and governance and social and all the various issues we know about their governments and how they treat their population, women, etc., etc. So this is a distinct difference to the energy complex. And the third one, which I think does reverse, is that China is now 40% of the emerging market benchmark. So emerging markets really is China plus. In China, as you'll be aware, Steve, but I'm sure the others are as well, you have more traditional stocks than you have what's called SOEs, state-owned enterprises, in which those companies are treated as an extension of the government. The government tells them what to do, what to spend, where to spend it, what to buy, and they jolly well do as they're told. Over a very long time, obviously, that is not a great way to profit maximize your business. It's just that famous Ronald Reagan quote, the scariest things you want to hear is, I'm from the government and I'm here to help. Now, I've said it lightly because I know I'm talking to politicians, but nonetheless, in China particularly, they get their corporations to do all sorts of things that are not aligned with shareholders' interests. So over time immemorial, being away from state-owned enterprises has been a profitable enterprise. However, in a world where Chinese lockdowns have lasted into perpetuity, and obviously they're getting some pretty aggressive riots for Chinese standards there today, it has crippled the economy. So state-owned enterprises simply have not fallen as much as the other stocks in the Chinese index. So you'll find most emerging market managers, ours and others, stay away from state-owned enterprises for very obvious reasons. But those are the stocks that have held up the best in the current climate where you've had lockdown after lockdown after lockdown. Now, the wrinkle is, against all of those headwinds, when I look at the 3 managers, one actually has managed to come in flat, so overcome some of those headwinds. The other is down only a moderate amount, so again has managed to offset some of those headwinds. The one that has not has been Genesis. It is down something like 4% over the same period. So then the question is, have we picked the right manager or the wrong manager? Why have the others been able to offset these headwinds and why have Genesis not? With Genesis, and you might remember this, Steve, probably from your time here better than I do, but Genesis were a manager that were chosen because they have a very long time horizon, much longer than other people, and you want your sources of alpha to bloom, if you think about it in gardening terms, at different points and to come from different sources. They are very strongly aligned and have been historically to the emerging market consumer theme. It's a very strong one to disagree with, but the timing is always quite interesting. So far, 400 million people have been taken out of poverty, so to speak, in China over the last 5 years. As that continues, and it obviously will continue to move in that direction, people buy white goods for the first time. They buy shampoos, or different type of shampoos for the first time, etc. So everyone moves up that consumer chain to become middle class in inverted commas, which creates a huge consumption boom. But as we saw in this country, whilst we're locked down, we don't spend any money. The opportunity to spend money is not there. So Genesis are relatively apologetic about playing this theme, but as those Chinese lockdowns continue, the stocks that they own have been hurt. Now, when it comes to where is the end for this particular manager, we have decided that if we know the environment hasn't favoured them for that particular reason, but as and when, and it looks like it's probably going to be more likely to be sooner rather than later, the Chinese are allowed back out of their houses to spend as they would normally do. If that manager does not perform in that environment in which they have said very aggressively that is their playground, so to speak, then it is very likely that manager will be facing some slightly more difficult conversations with a very pointed execution point at the end. What we saw 3 weeks ago is when there were some rumours that the Chinese lockdowns might be lifted, the Chinese market was up 15% and some of those stocks are up 30%. So we know there's this latent potential for a huge revaluation of those names as and when the Chinese government allows its population more permanently back out of lockdown. So it feels like a cold spring. The question I cannot answer you is when that cold spring unfurls, when indeed the Chinese government acquiesce and let their population back out. One has to think that has to be the end goal. I can't imagine a world in which they never come back out. But obviously the Chinese government has a longer term view than perhaps their population does, and certainly than I do, and we do in financial terms. So I do think there is the potential for that manager to outperform very significantly. We've seen glimmers of that actually over the last 3 months, but they have not been able to offset some of those headwinds like the other managers have. And if we move into an environment that is much more fertile, by their own words, for their stock selection capabilities, and they do not outperform, I think we can probably largely say that they will be for the chop in financial parlance.
Steve, did you have any more?
A few months ago, you mentioned on your equity active fund, which we own, that there might be some changes afoot later this year. I think David Cox mentioned this actually. Maybe consideration of some other smaller companies, maybe unlisted or something like that. I wasn't sure where that project was going. Can you tell us if there's anything? Can you update us on that, please?
We can. Was that in the UK equity fund? Sorry. Correct. Yes. So we've done some work to see what could evolve in this franchise. As you're aware, we kind of serve at the committee's wishes, so we would only evolve the fund were it wanted by all of its constituent parts. I've just felt since I've arrived, and I remember reading a paper from some of your from a consultant that suggested that the UK was a good place to invest because it gave you sterling exposure and it gave you exposure to the UK PLC. Well, it does neither of those things. You know, the UK stock market is very, very global. It's 80% of its revenues come from overseas. 25% of the dividends are paid in dollars. It has nothing to do with sterling or the UK. On the basis of that was perhaps the wish, we started to investigate whether or not, if people wanted, in tune with the levelling up agenda, in tune with what other clients may have been suggesting, whether there were other avenues to evolve this fund. We've done quite a lot of work. And that'll be coming to what we call the ISG soon, I suspect, just to sound clients out. So it's been done in the background, just so we can provide some degree of opportunity or suggestions for the portfolio. It can stay as is. It's a perfectly reasonable fund. It just does not give you, as I think some consultants have suggested, UK exposure. And so when I heard that being suggested at a couple of committees, I just put my finger out and said, well, let me go. If that's actually what you want, we could probably create something like that. So we've done the work and it will come back to an ISG. But really, if no one wants it, it will stay completely as is, because that is the current prospectus and the current remit.
May I respond to that? I mean, I think, I do think there's good value in areas of the UK market, and obviously we're going into a UK recession at the moment, and that will present opportunities as well. So, it's not going to be in the big companies, but I do think there'll be interesting opportunities further down the market cap spectrum in the UK, and lots of them, and they're local as well. So, yeah. I'm personally quite receptive to that sort of direction.
I would also agree, and I think perhaps someone in this committee last year asked me whether they should sell the UK because it's been such a perennial underperformer. And my instinct then was to say no, because a bit like where we are in the trough, you might be aware that the UK market is cheaper now than the emerging market equity world, and we are being treated a little bit like an emerging market by investors. So the UK stock market trades on 7.5 times forward earnings, which is incredibly cheap, cheaper than it was almost at the bottom of the global financial crisis. So again, I think the UK market has some potential to outperform in the longer term once we get past Brexit and weak sterling and all those other good things that have been an impediment for the last 2 or 3 years to investors making money in the UK.
Sorry, I just got a quick follow-up because that's interesting. That's 7.5 times earnings, which is like a very cheap valuation. Is that because of the oils and the banks, or is that generally across the piece?
It's largely across the piece. In fact, the oils and banks have re-rated upwards. It's just because our cousins across the Atlantic have given up on the UK. Every time they invested here, they lost more money in sterling than they made on the actual stocks, and so they've ceased to be an investor in the UK.
Sorry. No, I don't know. I'm happy.
Yes, thank you, Chair. I have a question which comes out of this emerging markets discussion we've just been having. And you've got these 3 managers who invest basically in China, which you said was 40% of emerging markets. And one of them specialized in, and correct me if I'm wrong, in those industries which are in enterprise zones, I think you said, which are largely government controlled or under government influence. And you expect
it's actually reversed. They've stayed away from those that are government controlled because typically they make bad investments. So they've as much as one can in China, they've strayed away. They've moved away from those stocks that have direct government intervention.
But the one that has underperformed, I think you said by 4%, and I can't remember what period of time that was over. I thought that not in those government controlled?
No, it's very much away from those, hence the underperformance. It's more in the consumer discretionary end of the spectrum. So corporations that benefit from Chinese people getting more wealthier and spending as perhaps we do or have done historically in this country.
Great, thanks for making that clear. But the question still applies because that area where they're investing and not done quite so well recently, you expect that area or that zone of investment to improve because of probable China government relaxations, if you like, that are going to come along. And you want to test that manager to see that they are performing adequately because they will recover better. Wouldn't it be strategic policy to, not micromanaging, by the way, I quite agree we shouldn't micromanage, but strategically better to actually get one other manager to go into that sector now so that they can perform similarly, and you can compare one with the other, the recovery one, if you like, with the new one, and also into an area where you're anticipating it should do better anyway.
So we wouldn't perhaps put a manager in just for compare and contrast purposes, but we do look at the entire universe. And actually, there are lots of managers who play this similar theme, which is the emerging market consumption theme. So we do benchmark Genesis against other managers that are playing a similar stroke, if you like, to ensure that we are getting the most bang for our buck within that theme. But what we wouldn't do is put one into the fund just to see how it performed relative, because it might not perform very well. But we do watch them around the outside of the portfolio just to make sure we have the best managers we can find, because as you're probably aware, active management, as Steve kind of alluded to earlier, doesn't always perform. And so actually then our job is to find the best of a bad bunch, if that makes sense. And because the active to passive decision is yours, and then within active, I want our funds obviously to outperform the benchmark, but if no one outperforms the benchmark, I want us to be near the top end of that particular pack.
Well, thank you. I think we've now had a very thorough question session. I just wanted to echo what Steve said earlier on about the improvement in the reporting style and the way the information is presented to us. I think it is considerably better than it has been previously. I very much welcome that as well. I'm not sure it's still exactly right, but I think we'll see how it goes for the next few months. And once we've got more used to this style, we might have some further ideas. But thank you very much for doing that.
It's an evolving brief, that one. We've deliberately chosen a provider that can allow for adaptation and evolution.
Yeah, I can assure you there will be further enhancements and improvements, and we've got a quarterly meeting with the clients to discuss what we'll do next. So that hopefully it will continue to evolve in a direction that is that you'll like.
Yeah. Good. Well, thank you very much for that reassurance. Okay, so we'll thank you very much for your presentation today. I think we'll move on to the next item on our agenda. On to item 9, Councillor Beasley, if you're ready to speak to us about your work and bring us up to date, please do so.
Thank you very much indeed, Chairman, and good morning to everybody again. The timing in the quarterly cycle is unfortunate again this time for the Dorset Fund, in so much as the next meeting of the Scheme Advisory Board takes place next Monday, the 5th of December, and the next Brunel Oversight Board on Thursday, the 15th of December. So whatever I say tends to be a little bit historic in this quarter, but I hope that I've got something useful to add, particularly to some of the points that have already been made. Very pleased in terms of Brunel that Tim Dixon is on the call again, and Tim is the head of customer relations, so somebody with whom I work, particularly around some of these issues which have come up in the past. And I think the 3 principal issues have been around the client reporting and presentation, so I'll just deal briefly with that first. So we have been listened to in Dorset, and I think it's fair to say that we have made quite a bit of noise about this. And the evidence of the response, of course, is in the pack this time. So I'm very pleased to hear both David and Tim saying this is work in progress. There are further refinements to be made. It needs to be more user-friendly, but we've made big strides so far. And I think I will be listening to the Dorset committee about issues which could be further improved. So if you want to feed any of that back to me, when you've had more time to think about it, please do so. What we need is it to be as compact as it can be, but as user-friendly as it can be, and give us the information we need in a clear presentational way. And I think good work's been done, but I suspect that members and officers will see further improvements that could be made. I think David...
Sorry, David. One second. What I'd recommend actually is if members look back to this report over the next few days and maybe email you, John, with any suggestions that any ideas they come up with, or copying David as well, probably. As we have this specific example today, and people are looking at it, so if they do have anything they want to suggest, they could email the 2 of you over the next few days.
And perhaps, Chairman, to include Tim Dixon in that circulation, because as head of customer relations, he's got an important liaison role to play. I've also separately, in meetings between our quarterly meetings, had conversations with both Laura Chappell and Denise Legall, and I've banged this point home there as well. So I think we've been very well represented in terms of the number of people in Brunel who've been listening to us. But yes, certainly, Chairman, please ask members and officers, it's important it's both, to do just that. I think in David's presentation he was close to talking about another issue which we've spoken about before, which is Brunel in terms of local impact investing. And this is happening, I think, in a couple of our county colleagues, but most particularly in Cornwall. I don't want to get into the detail of that, but it is certainly something which, provided we have the security of return and all the other disciplines we'd expect, that I think perhaps in Dorset we could be looking further at. So that's about local impact investing, as in Dorset, but certainly with all of those other caveats firmly in place. And perhaps outside of this meeting, our officers might be wanting to work together with our independent advisor about whether that is a viable suggestion, and if so, in which areas it might be taken forward in terms of examining how we could do it. The third one, which has been raised in the past, and the Vice Chairman isn't present, but I know he's been quite vocal about this in the past, it is around performance and is about what he has always termed as strategic plan B. I'm not sure that that is something that exists other than to ramp up pressure on performance as we have done this morning. I suppose it also hinges on how we are going in terms of transition as well. So Dorset at the end of September was 63% transitioned into Brunel, but of course we do have quite a lot of assets in 2 or 3 asset classes where transition is going to be very much all or nothing, and at the moment they aren't in assets which we would readily want to move in terms of its totality. So I think that is still for us work in progress. It isn't to say we will, it isn't to say we won't, but we've got to have suitable funds into which to invest. And I'm not sure, particularly in the property sphere, that's necessarily the case at the moment. And I know that when we're going to be looking at some of these issues in the future as a committee, particularly in one of our training sessions, that might be something we need to think carefully about, but to broaden it out into those other asset classes where we are more illiquid and where at the moment we haven't transitioned to bring that up. And the reason I mention that, Chairman, is at 63% we are lagging the curve as far as other funds within Brunel are concerned. Most but not all have transitioned to a greater percentage than that. So something perhaps that we internally should be looking at more carefully for the future. But at the moment, that's the situation. That's where we are right now. I think the issues around Brunel, many of those that we've been talking about will be raised in one way or another at the next meeting of the Brunel Oversight Board in about 2 weeks' time. If members have got anything they want to feed into me over and above, either inside this meeting or outside, please let me know. Could I just have a few moments now on the Scheme Advisory Board, Chairman? Because I think there are some issues that we need to think about. Whilst they're not specifically on the agenda at the moment, I've certainly had conversations with Roger Phillips, who's the chair of the Scheme Advisory Board, and what it presents for us is that opportunity to feed into that process. So the board is there to act, if you like, as a liaison between the government and the members, the fund members of the LGPS. And there is always representation from the department on our board meetings, which is quite interesting and quite useful, but I think needs to be used to greater effect in terms of that two-way flow of information. And most of that is around the government's position on pooling. So once the government's ministers have really got into their briefs within the department, so we've got Michael Gove back, as you know, as the Secretary of State, but it's the ministers below that who are the key points of contact with regard to the LGPS. Once we've got to that position, I think there are some issues which are coming forward around pooling, of which we need to be aware. I know that Laura Chappell and Denise Legall at Brunel are very well aware of them, and I hope that we can influence back through the board, through me, if at all possible. I think it's important that we do that. The levelling up agenda is one part of it, and that may be addressed in part through local impact investing. That's actually doing something on the ground that assists those areas of the country which could do with some more levelling up, but we're making it something we can do ourselves. I think perhaps more importantly is that there is some frustration at government, not about Brunel, not about those pools that are doing the job and doing it as the government intended, and there are some of them, of which we are one, but it is the government's frustration over the pace of transition more generally, and indeed the commitment to pooling by significant parts of the LGPS. Bear in mind this is a public meeting, I don't want to be specific about those, obviously, but they are areas where that frustration could boil over in the future. So we need to be making sure that we're backing Brunel in what its senior officers are saying back to government, because what we don't want is a heavy-handed approach from government which sweeps all of the LGPS up together and therefore gets in the way of the example we have set in Brunel as far as pooling and the commitment of transition is concerned. So I think it's important that we're conscious of that. The pooling regulations consultation is proceeding, and that will have an impact on it, but we shouldn't underestimate the pace of change that government may be looking for at this end of this parliament. And I think we also need to be conscious that they need to see the LGPS in the round. What we don't want are knee-jerk reactions because of the failure of some parts of the LGPS to perform. Something perhaps to take away out of this meeting. I'd welcome some input from officers and indeed members back into the support that we give to Brunel in representing the pooling function, but we do need to be conscious that this is dangerous ground if we don't get it right, and I'll do everything I can through the SAB to ensure that we are represented in whatever way you would like. So I think that just about sums up the two parts of my role external from the Dorset Fund itself, but I'm very happy to answer any questions, Chairman.
Thank you very much for that. Very informative, as always. I think it would be particularly galling if we were forced to make changes because of other people and other LGPS funds not having moved fast enough or quickly enough in the direction the government has wanted, when we have actually done so much good work ourselves to do that. But hopefully our position will be noticed by the government. Does anybody have any questions for Councillor Beasley on any of his work? No? Oh, yes.
I note with interest that Councillor Beasley has a board meeting on the 15th of December, and it won't have escaped many people's attention here. Of course, the 15th of December is the next meeting of the Monetary Policy Committee of the Bank of England, etc., and we all wonder about the direction of interest rates, both in this country and whether interest rates will effectively peak next year, both here and in the States. I think one could talk, I could certainly talk about the importance of infrastructure for the length of the day, but I'm not going to do that. I am concerned about resilience, the resilience to shocks. All that we've seen in the last few years, the uncertainty in China, and it's this resilience against shocks that really concerns me. We may be in a situation where the FTSE, which is relatively undervalued, is now above 7,500, and some people may take pleasure about the fact that oil is now around $80 to $85 a barrel. But it's this real concern about resilience to shocks that concerns me, because effectively one sits here as a representative of the Dorset taxpayer and trying to see that we do have a reasonable rate of return on our investments and to avoid shocks.
I'm not sure there was a question there really, but Councillor Beasley, did you want to reflect on any of that?
Well, only to the extent of just understanding the role of the Scheme Advisory Board, which is that link into government, but it isn't about financial policy, it isn't about specific investment, it is much more around the generality of how the LGPS and the government interact. But certainly, I mean, we have here officers from Brunel who will have picked up the points that are just being made, and I'm sure that's part of their thinking.
Okay, thank you very much. I'm sure it relates to what Steve will say later on as well, so I'm sure it will get covered a bit later on in the agenda. Thank you, Councillor Beasley. For that, I think we'll now move on to the Pensions Administration report. So, Karen, over to you.
Good morning. Can you hear me okay? You've all got a copy of the administration report. There's a few items that I have left in from the previous one because we didn't have the meeting where they were particularly important. The first thing covered there is the key performance indicators. You'll see that overall things are looking good. There's one or two areas where we continue to struggle. One of those is transfer out payments. And that's because we've had to divert staff from that area to dealing with the annual allowance this year, which is we've had particular issues with, and also with retirement quotes. And you'll know that we have lost a lot of staff, and I'm pleased to say that we are interviewing next week. We've got quite a lot of candidates. We're looking to recruit 7 staff at least. If we have good, strong candidates, we will recruit more than that so that we've got a lot of resilience going into McLeod and the expertise that we need. The second item on the report concerns just confirming to you as a statutory requirement for the fund to issue annual benefit statements, and we do this both electronically onto the member portal and by paper to home address. And we've issued this year over 41,000 of these statements. The cost is very small to the fund, and the benefits are huge. Certainly, they're very much appreciated by members. And it serves lots of really valuable purposes for us and meets a lot of statutory requirements as well, such as keeping addresses, etc., up to date, which is particularly hard with deferred members. We always also put in a newsletter. You'll see that on an appendix. This is also very useful. This is about important reminders and new regulatory changes that might be coming along. So basically, this is the only communication we do to home address to members. Raising awareness of the fund is particularly important, particularly in the current financial climate. There's a lot of financial pressure on people, a lot of scams and pension scams particularly. So it's really important that people understand their pension and the benefits that they get. It also reminds people of the death grant nomination. We do have a lot of issues with the payment of death grants to beneficiaries. That's a discretion for the fund. So that has to be taken quite seriously and can be quite tricky. The big thing, of course, is making sure that our data is correct, and members will make queries with us. We can check things with employers if we think that anything held is incorrect. Particularly important at the moment with the current care fund, because the data provided to us by employers each year directly calculates the proportion of pension earned in each year. So that was quite a successful programme, and we met the deadlines for that. I'm going to include as a regular feature on the reports about the dashboard and McLeod, just to keep that high in profile. The pensions dashboard won't probably go live to the public for quite a few years yet, and that's because every pension provider in the country has to onboard before it can go live. And we are currently looking at an ISP provider to choose and to enable the Dorset Fund to do this. And we will probably start onboarding towards the end of next year or the beginning of the year after. So there's a lot of technical and legal issues surrounding the dashboard that are currently being discussed. And just to let you know that we are making the appropriate preparations for that. McLeod, you will have heard me talk about before. This is going to be, before the dashboard, certainly this is going to hit us. And this is going to be very significant in terms of the amount of work that is needed, potentially not hugely for any great financial reward to members. The LGPS, out of all the public sector funds, really is the one that's current scheme benefits are good compared to where they were. Our accrual rate is currently 149th and it was 160th. So the amount of people that will benefit from this change, which is the increased underpin, isn't necessarily huge, but there will be some benefit to some members, and every benefit that has been done since 2014 has to be revisited, and all benefits paid in the future have to have an underpin check. So there will be a huge amount of work over the next few years. I think it will be literally a project that will last for several years. Really important for McLeod and for the valuation, for everything that we do, is the data quality. And every year we look at our data and its quality is measured. We have to report our data quality to the pensions regulator, and that's also mentioned in our annual report. And this is really important for many reasons. Obviously, having correct data is essential to payment of the correct benefits, and that the valuation is correct for employer contributions. We were concerned, obviously, about our data because we've changed to a new system and all our data has been migrated. And we have done an extraordinary amount of work to make sure that our migration has been done and done to a high standard. And I'm pleased to report that the data scores are looking really good for this year as well. The common data is still over 99%, and the scheme-specific data, so that's the data that is specific to the LGPS, is slightly down on last year, but still really very good. And I expect that to increase next year when the reporting functionality that we've got with our new system is improved. So I'm pleased to report that that's all looking good, and the data improvement plan is attached if you wanted to have a closer look at that. I've mentioned the valuation. That's been a valuation year for us this year, so there's a huge amount of work that has gone into that. And I'm very pleased that everything was extracted and passed. A huge number of errors were addressed, and our data is of good quality. You'll also be aware that the actuaries took into account consideration for McLeod. Obviously, this is based on their best guess, if you like, of what that might mean. Climate risk was taken into account this time. We also commissioned a separate report on longevity coming out of the pandemic, and that was very interesting. And obviously the outcome overall is that life expectancy are lower than they were at the 2019 valuation, and that it was estimated that improved the funding position by around 3%. Obviously, mortality rates for the fund did increase during the pandemic, largely, of course, in the older age group. What I've also noticed in the Dorset fund is there's been a very sharp increase in the number of ill health retirements, which is probably, again, a reflection of the pandemic and the knock-on impact to general health. And with ill health retirements, the cost to the fund isn't immediately passed to the employer. That is, in fact, taken into account as part of the considerations of the valuation. So the fact that we've seen about an 83% increase in ill health retirements over the average that I took from the previous 7 years, I think is significant. Whether that will continue, and if so, for how long, we don't know. Also, just to inform you that we have started an overseas existence check. We aim to do this every 3 to 4 years, but we have not done it during the pandemic for obvious reasons. So the fund is able to do mortality checks on our normal pensioner payroll because we buy a facility that enables every death in the country has to be registered. But that, of course, doesn't include pensioners living overseas. So we've got over 450 pensioners living overseas in 28 different countries. And we are using Western Union, as we did previously, to help us with this existence check. This is underway. This involves communications going to our pensioners, and they are required to either go to a Western Union office where they have to have their identity checked, and they are rewarded with a £10 equivalent in their currency for their time and trouble. If they're unable or unwilling to do that because of their location or their health, for example, we arrange a telephone call with them and we ask them some security questions, just really to verify that the right person is receiving the pension and that pensioner is alive. So that I will let you know the outcome of that. That's ongoing at the moment. So that's the main highlights of the report. Does anyone have any questions on anything there?
Thanks. Yeah, it's actually just a slightly later section. It's an interesting report. Particularly, I found the overseas existence checks an interesting area that I've not sort of considered before. The bit about employer updates, section 9 of the report, it talks in there at 9.2 about Bournemouth Transport was in the process of setting up a deferred debt arrangement to manage outstanding liabilities to the fund. However, Bournemouth Transport's now gone into receivership. Are there any financial consequences from that in terms of the sort of, is that for the fund or for members of that section?
There's not financial consequences to members, or in fact, so this is specifically with Bournemouth Transport you're referring to here, is it? Yeah, so their liabilities, and in actual fact, they were fully funded. So they're in a good financial position, but those liabilities will go back if they can't meet any exit payment, and everything is in the hand of receivers at the moment. And exit payments vary whether they are full cessation or if there's another employer taking on those liabilities, which sounds a bit strange, but that is how it happens. And what will happen in this particular case is it will go back to the transferring authority, which is BCP. And that won't have a damaging impact to them because of the good funding position. So there's a difference when an employer ceases as to whether there's what they call an ongoing basis or a full cessation basis. And the difference between that really is whether an employer is picking up their liabilities or not.
Yes, we have, if I remember correctly, a few years back actually had discussions in the committee when there were particular issues with another company that got into financial difficulties. We had to work out a system of payments. But by and large, these matters are dealt with appropriately between the officers and between the companies involved, and don't ever come to the committee because they're solved without any financial issue to the fund. But Councillor Beasley, I believe you have a question as well.
Thank you very much indeed, Chairman. I just want to ask Ms Gibson a quick question about McLeod. It is frustrating, of course, that this has been pushed further and further away, and one can only suppose why that might be. But my question, I think, is to ensure that in this part of Dorset Council, as far as the pension fund's concerned, are you confident that you have sufficient resources to deal with this, both in terms of the consultation stage and more particularly about the practical implementation stage? Because if, I necessarily need to ask, I think there's a governance issue in here, and I think the committee probably would like some clarity around that in particular, although there are some other areas where you might want to comment as well. So I will give early warning if it's likely that there would be any kind of revenue implications as far as administering this process is concerned. Thank you, Chairman.
Yes, thank you, John. I mean, when it comes to McLeod and resourcing, there is a huge concern nationally, and that's because of the technical expertise and knowledge required to deal with this. It's sort of quite hard to find, and that's why we have lost staff. But in actual fact, I feel we're in a good position because we have been able to look at the grades that we pay to our staff, and we are recruiting. And if we can, we will be recruiting more people than we have vacancies specifically for resilience for McLeod. So at this moment in time, I feel as confident as I can be because we can't really predict what will happen with our staffing. We know that this is going to be absolutely huge and significant, but I sort of feel confident that we have what we need and that we will be supported in getting anything in addition that we need to help us with McLeod. So I think we are in a better position, I would say, than most funds, and certainly with the good quality of our data as well.
Thank you. If you'd have to redo it now. No. Okay.
It's not the specific capacity in which I'm engaged here, but in another capacity, I oversee administration, so I'm kind of always interested in administration. I know what a problem it can be. Just a couple of suggestions for the members to think about, to ask, and I don't know whether Karen's reporting enables this, but I noticed on the KPI reporting, there's no, I couldn't see any indication of past due. In other words, once something goes past its KPI, whether it's then resolved in 1 day or 90 days obviously makes a big difference. So I couldn't see any kind of reporting around that type of issue, which I think will be kind of quite helpful to know, well, if we miss our SLAs, how much do we miss them by? And then the second thing is I couldn't see any reporting on complaints, because that's another quite useful indicator. Are our members complaining? That, I don't know whether you log that, or I expect you do, and whether that's something you can report on, but it's not for me to directly ask those questions. Maybe that's on behalf of other people.
So firstly, and you're quite right, this is a frustrating thing with the KPI, is that you miss a target, and are you missing it by a day, or a week, or a month, and that's really significant. We do have that information. We don't report that to you, but we do have that information. So that gives us an idea of, exactly what is going wrong. Are we just missing this, or is it something a little bit more than that? So we certainly do have that detail, and we can extract as much information as we need and want. And in actual fact, the reports that we give to you are a snapshot, and we have much more detailed reports, that we produce just internally for management purposes. So if you need any more information, do feel free at any time to ask, because it is all there. And you'll see that I've added on things like the number of processes that have been worked on and completed, and the number of calls. The number of calls is significant because we do offer a really good service to members because of this, but what we don't know is how many emails that we get in as well, and that's significant. And that's something that is harder for us to report. So there's certain things we can report on, some things that we can't. And I endeavour to just give sort of a summarised version of best we can, the most important aspects. But if there's anything more that you feel would be really significant, please ask, and we will endeavour to get that to you. When it comes to complaints, and we do have complaints, they vary considerably. If they become more serious, they go through the formal IDRP process. Now, those have to be reported each year, the number of cases that we have that go to IDRP, to the pensions regulator, and we keep a record of those. What I can do is perhaps once a year just update you on the number of complaints that we have. A lot of the complaints we have are people complaining about things that you can't change. So, for example, the contribution that they pay, or the fact that they can't have a refund, or the fact that they're only entitled to a refund and they want a benefit. So a lot of the time people would complain about the regulations not giving them what they want. So, we don't want to really necessarily report on those, although they can be quite time-consuming. Then you get into the more serious complaints that is generally around things like the payment of death benefits, for example. That can be quite contentious. And there's maladministration as well. So there are more serious complaints. And I do have a log of all our complaints, but particularly where they go to IDRP, because that is, of course, the most serious end of the complaints. Shall I add that in for future? I think it would be quite useful, wouldn't it, for you at least annually to have a view of the number of complaints we have.
Yes, I think that would be very helpful to add that extra information in. I think members should feel some comfort as well. Sometimes these issues we do discuss them at pre-meetings and bring up other issues that don't always come to the committee, because we look into an issue and find that there's nothing really to report about. But we are more willing to discuss other matters as and when needed. Councillor Roberts, you have a question.
Yes, thank you, Chairman. On the KPI number of days, on various other things within the council, such as land searches and process of planning applications, we actually have an average number of days that it is taking. We could possibly have a column, because although a percentage shows the number that are achieved in the time, are the ones that aren't achieved taking a very long time, or as you say, it might be an extra day. So the average number of days might be more of a guide or an additional guide to the resolution of those. Thank you.
Yes, thank you, Councillor Roberts. I think you're quite right about that. I think there's something we can look at in the future. I think we're very open to making changes in reporting, and it's just a question of spotting something we're missing or not explaining currently, and then we can make the changes accordingly so that they become regularly part of the agenda that you receive. There's no problem with that whatsoever. Any other questions? No? Karen, did you have anything else you wanted to add?
No, the only thing that I've not actually covered is the item 12, which was the annual report. And you'll probably be aware of that and the LGA statistics for England and Wales LGPS. You'll know that the September CPI was 10.1%, and that is the figure that is used by the LGPS for several things under different regulations. Firstly, for increasing pensions and payments in April, and also for increasing active care accounts, and also for increasing the contribution bands. So I think it's interesting to see what will happen. We have no indication yet that there is no intention to stick by the September CPI for those increases. But obviously from the government's perspective, we are the only funded public sector scheme. All the other public sector schemes are direct cost to the Treasury. So the increase of those pensions is going to be significant. The Dorset Pension Fund paid out over £114 million in pensions last year. And on top of that was obviously death grants and retirement grants. So the 10.1% increase to pensions is quite significant, I think. And that will be to deferred benefits as well. And it will be interesting to bear in mind that the contribution bands will go up by 10.1% as well. That might have a knock-on impact of people dropping down into a lower contribution band because the increases to pay isn't the same as the CPI. So in terms of cash flow, we might find that interesting to have a look at that in future years. But I thought it was worth mentioning that the CPI is quite significant to the LGPS benefits that will be paid going forward.
Okay, thank you very much for that. Any other questions on that last piece? Everyone's okay with that? Okay, well, thank you very much for that, Karen. Thank you. Moving then on to agenda item number 11. Steve, over to you.
Yes. Okay, so I was going to talk about some macroeconomic things like the economy, inflation, and so on. And then I was going to talk about performance as well. Some of these points have been covered in the earlier conversation with Brunel, so it might be a bit duplicative. I'm never quite sure what they're going to say in advance. So economy, inflation, and markets. Let's talk about that first of all. Obviously, just recapping, 2022 has been a very difficult year. Equities have gone down, bonds have gone down, interest rates have gone up. We're heading towards a recession. In the case of the UK, it may be a severe or long recession. So that's going to be a difficult environment we're in this country. And then later on, we'll talk about the impact of all that on performance and the fact that we're behind benchmark. So on the economy, we've talked a little bit earlier on about inflation. There are maybe some signs that inflation in the United States might be beginning to peak already. The CPI there has peaked. We don't know whether it's a permanent peak. But that's a glimmer of good news at the end of the tunnel. UK inflation probably won't peak until next spring. We're not sure whether it's going to peak in the mid-teens, low teens, high teens. And probably more important than these peaks will be the level at which inflation settles down at over the next few years. And we don't, obviously, economists don't really know that because, we don't really know how the Ukraine situation will resolve itself and the impact that has on gas and oil and so on. So it's obviously a highly uncertain environment. Interest rates, at what stage can we begin to expect that rising interest rates will slow? For sure, we're going to see higher interest rates next year. But again, the markets are quite sensitive to to the second degree of change, the second derivative of change, when the peak starts to sort of come in sight. The markets are definitely looking for that kind of sentiment change at the central banks. It's a bit early for that, but that's what we're looking for, and that's why that's one of the reasons why the markets have stabilized a little bit in the past few weeks, because things like the US inflation rate beginning to peak, maybe a hint that the UK inflation rate may peak in the States, that inflation will be declining in the United States by the second half of next year. Obviously, as soon as we go through the 12-month anniversary of the invasion of Ukraine and the gas price spike, naturally, that immediately starts to have an impact on the thing you're comparing yourself against 12 months ago is an easier comparison. I think basically we're right in this phase of worrying about interest rates and inflation. That's kind of phase one of what happens when you go into when you have a recession. There's a kind of phase two where bad things happen in corporate space, where profit margins fall, where profits are weak, where you get corporate defaults. We've seen very few corporate defaults so far. I mean, there are one or two headline things. There's the crypto fiasco, but I'm not even going to talk about that. So we haven't really seen corporate defaults on any meaningful scale yet. But I just like to, we always need to remind ourselves markets will bottom before the economy bottoms. They are an anticipating, discounting ahead thing. So, at some stage, the markets will start to bottom out. And my feeling is that I'm not saying we're passing the bottom of the markets now, but I've got a feeling that phase one of the bear market is over. And the good news is that value is now starting to emerge in equities and in corporate bonds and in bonds generally. So price to earnings ratios, this ratio that is used, David mentioned it earlier on, which is the valuation of the price of equities compared to the profits they generate. That ratio was very high 1 year, 2 years, 3 years ago. It was in the 20s. It's in the States. It's now come down to the high teens. And in the UK, David mentioned something about it's fallen into single digits. So value is definitely starting to emerge in equity markets. And bond yields are starting to become more attractive. It's been impossible to find good value in bond markets in the past few years. Corporate bonds were yielding, only 2 or 3%. Now, high-quality bonds are yielding 4, 5, 6%. High-yield bonds that are sub-investment grade are yielding, sometimes more than that. So there is value starting to emerge in asset space. There is good news starting to emerge for investors, and whereas I think if you'd asked me a year or two ago, it's been really difficult to find decent prospective returns going forward. You can begin to see that, bonds and equities are more attractive. Resilience to shocks was mentioned earlier by Councillor Christopher. Absolutely, we should always be thinking about resilience to shocks as an advisor, when we come to our strategy review, which we're coming up to as a committee. So that's important. We of course have a mechanism for recording risks, which is our risk register. So I'm not quite sure the frequency with which we record that, but that's a good place to document our responses to what we think are the risks to our strategy. But nevertheless, having said that, we should always be thinking about our resilience to shocks, and I welcome any debate on that. I was going to talk about performance next. So that's all I was going to say on the economy. It's just like headlines really on the economy. As far as performance is concerned, yes, we are having a difficult time. So the one-year performance, it's in the reports, minus 7.2% over the past 12 months, versus minus 2.4% for the benchmark. So we're about 5% behind benchmark over the past year. The 3-year numbers have come down also, and are lagging benchmark on an annualized basis now, up 2.3 versus up 3.5, and for 5 years, up 3.8 versus 4.7 for the benchmark. So what do we think about this performance? So I think about this in two ways. First of all, let's think about the absolute performance, and then let's think about the relative performance. So by the absolute performance, I'm referring to the performance of our fund, irrespective of the benchmark. Well, down 7.2% is disappointing, but as I said, values emerging. It can and at some stage will recover. The 3 and 5 year returns, the numbers I just quoted, were only 2.3% and 3.8%. That's below our discount rate of 4.9%. So we're not hitting our discount rates over the cumulated 5 year period. So the annualized 3 and 5 year period. So we're not making a required rate of return, and that's disappointing. But we are at a low point, or we're getting towards a low point in the cycle. So that's a comment on absolute performance. As far as relative performance is concerned, and that's a function of our asset choices and a function of our manager performance, our Brunel internal and external manager performance. There's some performance attribution on page 6-7 of the Brunel report. And actually in Q3, we were 1.6% behind benchmark on a relative basis. The bottom line that I draw from the performance over the past year is that the poor relative performance over 1 year is not really principally due to asset allocation. Although I would highlight things like we have allocated 10% to sustainable equities, which were down 12% when global equities are only down 3%. It's not really primarily due to those kind of asset choices that we make. It's mainly due to the manager selection, internal and external. Mainly by internal, I mean Brunel. So I think it's mainly internal. Some of the external managers, we held the Schroders Fund, and that performed poorly. The Royal London Fund has not been great over the past 12 months. But actually, some of our external managers are still showing very good numbers, like Harbourvest, Aberdeen, IFM, even Hermes, very good positive over 12 months. But it's mainly, the relative performance is mainly about Brunel. So then we get into the kind of, why is that? And it's something we should be very focused on as a committee, and we should continue to scrutinise Brunel, as I say in my report. And I think you'll hear the same discussions going round again. We had them a little bit earlier on. Brunel is a responsible investor. Our philosophy is to decarbonise and to invest responsibly. We write it in our annual report. That has hurt performance, unfortunately. Question is that temporary or is it ongoing? And this question, is there a conflict between responsible investing and fiduciary duty? David Vickers has said very clearly, and sent a Brunel circular email to this effect last week. He doesn't believe there's a conflict at all. In fact, the two are absolutely aligned in the longer term. Nevertheless, the Brunel performance, page 11 of the quarterly report, is poor. As I said earlier on, of the funds on page 11, not one listed fund has met its outperformance target since inception, and all but Global High Alpha have lagged the benchmark since inception. So it's not a great record, and we're going to have to live with that for a little while. We don't have 3-year records yet on many of the funds. So, what is the problem? I mean, I'm a little bit. I don't think David is like blaming it on this, but I don't want superficial blame on the Ukraine crisis. I think that was an external, exogenous impact. But to be fair, he's partly blaming the quality growth bias as well. But my kind of gut feeling is that some valuation discipline was lost in appointing some of those fund managers that Brunel appoints, 1, 2, 3, 4 years ago, in the pursuit of the RI agenda. So I think something's been lost there. And as I said earlier on, I believe in responsible investing, but I really do believe it needs to be smart. It needs to be not drawn into overpaying for assets via your fund managers, or not appointing fund managers who then overpay for the assets on a valuation basis. The Brunel performance is starting to recover. There's a bit of recovery going on, and I think it probably will recover, but it will only be sustainable recovery, and it will only recover it all if they pay close attention to some of these valuation things that I'm talking about, as well as quality growth and responsible investing. So it's going to be a challenging period. We continue to scrutinise Brunel. So those are most of my comments. I've been making notes as we've been going along, because I thought we had an excellent training couple of days in September. I thought that was really valuable. We had time to get into detail in things, and it resulted in some what I believe will be improved strategy. As we've been going along, I've been writing down things, and I know Dave and I are having a catch up on when we're going to plan that kind of training in the spring. But I've been writing down various things that were already mentioned at the last committee meeting on November the 9th for the training. There's a bunch of things here. I'm just wondering how we're going to get through it all. I don't think we need one day. I think we need about 3, unfortunately. So that might be the next three training days covered. Thank you very much for your comments. Happy to take questions.
Thank you very much. And I agree particularly with the responsible investment, which I've raised on previous occasions. There are a couple of little points I wondered. I'm not quite sure I agree with your terminology of unfunded tax cuts. Tax cuts can't be unfunded. It's just less income, but you've written unfunded tax cuts from the trust government. It's just, you don't fund tax cuts, it means there's less income. They were going to fund the spending by additional borrowing. And so I think the term unfunded it was widely used, but actually no one challenged it. If you receive less tax income as a government, you don't say we've got less funded income. But it's just a principle. Okay. I think that's wrong. The other thing I'd noticed in Q2 in the report, that the overall value of the fund had grown. It looks like we're at 3.4 billion. Does that offer us a slight buffer against the low performance?
Well, that includes the performance. That includes the performance over the past quarter. Sorry. Oh yeah, that includes the performance over the past quarter and past 12 months. What we don't get is we don't get a quarterly update from the actuary on what our funding ratio is. We heard about it at the training session in September. So that's kind of something that I would be interested to see. But when we think about buffers, personally, I always think about, therefore, what's our funding ratio? And I don't know what that is on a kind of live basis at the end of Q3. I don't think we have that data, do we?
Sorry, maybe I'm asking, are we expecting the fund to continue to grow in total value or not?
We are. Absolutely we are. Yeah, I mean, our whole strategy is based on, if you remember, 4.9% on average over the remaining lifetime of this fund. The assets we're trying to get them to grow at 4.9% per annum. But obviously the variability around that is huge.
Yeah, yes, as I say, I mean, there's a whole bunch of different ways to measure this: absolute return, relative returns, all the rest of it. But the key thing we have to keep coming back to is we've got to beat the discount rate that the actuary set us, and that's 4.9% in the next 3 years. And if we fall short of that, that's what leads to problems with having to go back to employers and asking for additional funding. And that's probably is why that's the single most important factor from our point of view. But of course, the relative side of things is much harder if we're underperforming in the relative side of things to hit the absolute targets too. And it shows that potentially our managers are missing opportunities or could be missing opportunities. But I think you're right. I think we need to look at any situation where a whole bunch of funds are all behaving in the same way and they're all underperforming collectively at the same time. You do have to investigate, therefore, why that is the case. And then if you convince yourself, what Bruno is saying, are they being legitimate in explaining those reasons, or are they just temporary factors, or are they permanent factors that might be a problem with the way they've gone about selecting the managers or where they're operating? And depending on what we decide where the problem is, there are different solutions. Though having said that, we can't take money away from Brunel really, or that would be very politically difficult to do. But we do need to dig deep and get them to be responsible and analyse themselves why things have happened the way they've happened. What we don't need is facile excuses. We need them to really think about it and study the way they're operating. Do you want to add something?
So I just pick up on something there which I think is strategically quite important for this committee to be thinking about and developing over the next year or two, and that is, what is the strategic plan B? John Beasley, Councillor Beasley referred to it earlier on. It is a challenging situation. The chairman's just referred to taking money away being impossible, but there cannot be difficult, but there can't be no alternatives. That's not a sort of, you know. So I'd like to discuss this in one of these training sessions. Maybe now's not the time.
Yes, it's unfortunate the Vice Chairman isn't here because that's a topic he has regularly raised, the Plan B.
I think it's safe to say that will continue to be a debating point right through the development of the strategy, and trying to fundamentally we need to look at every aspect of what we're doing. You know, that's what a strategy review is all about, and looking to see whether there is a possible plan B or not is a key and clear part of that, or should be certainly. Councillor Christopher was next, and or were you speaking about this specifically? Oh, okay. Sorry. Councillor Christopher next, then Councillor Beasley.
Yes, I welcome your willingness to dive into detail. Could you comment, please, about the poor performance of Royal London and Mutual? Can we hear a bit more about that, please?
Yeah, good question. We haven't really talked about that. There's never enough time at these meetings, basically. So yeah, that's been. They had a number of years of good performance, and then of course over the past 12 months, what has happened is that bond yields have moved up. In other words, bond prices have moved down, but the spreads, corporate bond spreads, have increased. So that means that the spread, the higher interest rates that you get for investing in corporate bonds rather than government bonds has widened. Widened means increased. So whereas a year ago you got maybe these are ballpark numbers, very ballpark numbers, 1% for investing in a government bond, a 1.5% spread over that for investing in a corporate bond. So that's 2.5% if you're investing in your corporate bond. Forgive me if I'm just sort of really trying to spell it out. Now we're in a situation where government bonds may yield 3%, and corporate bond spreads are let's call it in the region of 2.5%. So they're 5% versus 5.5%. Sorry, 5.5% versus the 2.5% is the increase. And that process of that corporate bond going from 2.5% to 5.5% yield, I mean, the inverse of that is that the price has gone down. So it's been a bit of a challenging environment for the corporate bond managers. So they've had a little bit of extra spread that has increased, that has made it more difficult for them. And they have also secondarily, they had take a little bit of what's called duration risk, which is that they hold bonds on our average slightly longer than the benchmark. So the decline, I can't look it up quickly in the absolute return, is quite sharp. To be fair, in the 2020 strategy review, Mercer did point out that there was a little value in corporate bonds, and at that time we didn't change it because we were looking at the recommendation to switch into private debt. And I think, in retrospect, perhaps we got a bit too hooked up on the attractiveness of private debt rather than the unattractiveness of corporate bonds. So maybe in hindsight, we should, a couple of years ago, have decreased our weighting in corporate bonds. The situation now, I mean, we've had a number of meetings with the fund manager at Royal London because we hold that fund directly, and we're now beginning to hold some via the Brunel units, and it's exactly the same fund manager and virtually exactly the same fund. They are a really, really good, sound fund manager, and although yes, corporate bonds have been down over the past couple of years, value is starting to emerge again. They're a highly competent manager, as I said, and I'd have a reasonable amount of confidence in it going forward that they're not going to repeat the episode of the past couple of years.
Thank you. I just want to slightly add to that. I think, if memory serves, we did actually reduce our corporate bond exposure. The debate was whether to go down to zero or not. And I think that's the step we weren't prepared to take, being too large a bet at that specific time.
This is before my time, so I'm trying to remember what stuff that history that I'm not quite sure of. But yeah, okay, good.
Councillor Beasley.
Thank you very much, Chairman. Well, it's reassuring to hear Steve Tyson talking in those terms about rural London, because I think we all have been impressed by the underlying performance over a very long period of time. So I think that is helpful to us. Two things I wanted to ask Steve Tyson about. The first is, and he's referred to it in his presentation, is this negative return, the one-year performance of 7.2%, bearing in mind our discount rate, bearing in mind the impact that may have in the longer term, again, and even against benchmark, how very different this situation is from anything that most of us have been through since this fund was working with the aftermath of the financial crisis in 2008, 2009. That was pretty horrific too. But these figures caused concern, I think, to all of us. So the question is, around our strategic review, presumably, how much faith do we have in what David Vickers has told us from the Brunel perspective as to how this might right itself to some degree over time, and therefore begin to flush these variances out of the shorter term figures, but the impact on 3-year performance in particular is something which we aren't used to seeing. So I'm wondering whether the balance in there about how much faith we have in that turnaround is well founded or not. That does lead into the scenario of a potential plan B, but I think the potential plan B perhaps is about how we, as one of the 10 constituent funds, can influence where we are able to invest. So I really welcome what Steve's been saying about smart, responsible investment and how that is something which we need to continue to press Brunel about. What I think we need to know is whether that sort of RI investment is available in the way that we need it, or we think we need it, coming out of that strategic review, or whether we need to shape something different through Brunel so that we can satisfy those concerns. And I think that's how we look at a plan B, rather than all in, all out, where we haven't got that opportunity anyway, frankly, is about how we shape the potential for us against the investment vehicles that are available through Brunel, and how we can sharpen that up at some pace, perhaps, out of the review. Just be welcoming of those comments, please.
That's some really helpful framing of the kind of the topic. So I'll try and sort of take them in a bit at a time. How much faith in the kind of Brunel story that it will turn around? I mean, faith is. Sorry, I don't want to get into. So there's a measurement of how the degree of that. I do think, as I said, I think the performance will start to turn around, but I can't say I've got 100% faith that they'll recover what they've lost and move on to meet those outperformance targets that they've planned that they would have over longer periods of time, because I think those are quite ambitious targets. So that's a kind of general comment. I've got some faith, but not 100% faith. And we will continue to probe around the robustness and scrutinise the detail of their investment process so that we kind of get more faith or not. As far you mentioned the comment about the 3-year performance numbers, that this pension fund hasn't been used to seeing negative 3-year performance numbers. I mean, those bad 1-year numbers are in, they're baked in now, and my feeling is that we're going to have to live with some negative 3- and 5-year numbers for a little while. Actually, unfortunately, that's life. Plan B, so, I think your comments helped shape Plan B around kind of smart RI and all those things, requesting things of Brunel. I'll make a couple of comments about that. One is that Brunel already have the investment vehicles to invest smart RI. I mean, when I think about smart RI, I think about something I've been saying for the past few years, which is that, smart RI would have been really kind of being prepared to invest in some companies that are dirty, are cheap, are turning themselves around so that they become greener and more valued by investors. That is absolutely what you want to do. And I don't know whether there's sort of hint that they're doing a bit of that, but maybe maybe their managers haven't done enough of that. The vehicles already exist for them to do that, I think. I mean, we can push them in that direction, we can try and influence them, but the underlying vehicles are actually there. And I'm sure the underlying investment managers, even the Bailey Giffords of this world, who are out and out growth investors, are thinking about all these things and their performance and how to turn that around. And then the other thing I want to say just about Plan B is that there would nothing delight me more than to have a Plan B written down, documented as a strategy for the next sort of 5 or 8 years, with multiple options on it, one or two of which you mentioned there, which include that option, and then to throw away that piece of paper in 10 years' time. That would be that would be a fantastic outcome, because Brunel have turned it around strongly, and the performance is good on a 5-10-year basis. But I just think it's wrong at this stage to kind of not have not to be working on what the alternatives are, because although we don't need to think about those yet, in 3 years' time, you might need to think about them. And you can't work plans like that up quickly. That's...
Thank you, Steve. Did that answer your points?
Well, it does, yes, and I'm grateful to Steve for making them. My concern is that, and in terms of our investments, as far as Dorset's concerned, I'm no apologist for Brunel. The role I'm doing isn't specifically that. It's trying to create this liaison, but more importantly, making sure that our priorities are listened to and acted upon. And I think in this case, I would be very encouraging of developing a Plan B around the kind of strategy that I think's now buzzing around in people's heads, and perhaps out of whatever work we're able to do in the shorter term, we can shape that a bit better, and then put pressure on so that we are investing where we want to invest, in funds that are actually doing what we want them to do. So I take the point that Steve's making, that some of that is there. It's just that I don't think it goes far enough to satisfy our appetite for where we think we should be in that part of our portfolio.
Thank you for that. Can I just follow up a bit, actually? Do you feel that we have enough information on the individual fund managers, the current situation? Because when David comes along and talks to us, he talks about the overall strategy. He mentions individual managers and how they're set up and that sort of thing. But do we have enough, or do you have enough information to really get behind what those funds are actually really doing?
That's a great question. Well, actually, I, for the first time in the past couple of months, I feel I do, because I have, as Dave has, but committee doesn't necessarily have, and it's really detailed stuff, access to something called the Brunel portal. And on the Brunel portal, it took me a little bit of time initially to master the technology, but it works. And I can now access some of their internal reports. I've signed a confidentiality agreement on that information, which gets into quite a lot of the detail of the reports. Their regular reviews of the portfolio managers. There's a lot of data. They have got tons of data. This is absolutely great to see. They are doing the right things. I just think they've made some slightly erroneous judgments along the way, a couple of years ago, but that's work, that's still work in progress. I absolutely think they've got the right. They've got lots of really good quality information that should enable them to take the right judgments, and I'm seeing some of that information now. We don't want to get. At the end, we've appointed them to outperform their benchmarks and to hopefully make up performance targets. So, I don't think we can become intrusive, but we can ask difficult questions. And I think we are beginning, for the first time, I've only felt this in the past couple of months, started to see kind of really detailed information. And there's even almost too much for me to absorb. There's like hundreds of pages of detailed information. So that's really progressing, and they have got some great data, and we have to have faith that they will use that data wisely.
It's more a question for John as our representative. Are we alone in having these concerns? Because what I'm not hearing is that the other 9 perhaps have equal or even more concern, and what the feeling is amongst the other 9 members of Brunel.
Well, I'll try and answer that, but I'm bearing in mind that this is a publicly broadcast meeting, and I can't speak for the other 9, obviously, but it is a theme that comes across from some of those funds, but not all, I think I would say. We need to be developing our own agenda around this, don't we? And I'm picking up the messages that help me to do that at the Oversight Board meetings, and I'll try and take it forward elsewhere as well.
Yes, if I could just add to that as well, is I think members of the committee will remember that Brunel are undertaking what they called a strategic review, and they were looking for feedback from their client shareholder funds. And one of the top line thing that we fed back to them is that we want them to focus on doing the basics better, i.e. delivering the performance of the portfolios that we've put our money in, ensuring that over the longer term or the medium term they're meeting their objectives. And I think that is a message that came back quite clearly from the majority, if not all, of the other funds as well. So I think there is a consensus around that we must remember what Brunel's been set up for. Brunel's been set up to deliver investment returns, to effectively take the burden off the scheme employers that otherwise have to contribute to the fund. So I think there is a clear consensus in that, but there are perhaps different emphasis that other funds may have on perhaps responsible investing, for example, where you've got perhaps a wider spectrum of views. But I think certainly the message has gone back loud and clear to Brunel that doing the basics better, focusing on the investment performance, everything is geared to investment performance. So we talk a lot about responsible investing, but that, as David Vickers said when he was presenting to you, that must be there to deliver the financial return, not in and of itself.
Yeah. Thank you. I think it was before Steve's time, but I remember a meeting where 3 members of Brunel's staff came down and spent at least an hour talking to members of the public about responsible investment. And I had to ask why in that hour they hadn't mentioned returns to our pension fund. And that is why I still have concerns about this.
Well, thank you. I think that's been a very thorough debate, as it should be. And you're quite right to point out that we shouldn't be naming names or anything like that about other managers. But yes, we should look for allies amongst the other 9, where we share a common agenda and a common requirement. I'd like us to move on now to David, to your investment report.
Thank you, Chairman. David Wilkes, Service Manager for Treasury and Investments at Dorset Council. I don't propose to go through the report in detail, just highlight some key points. I'm happy to do my best to answer some questions, and I think some of the material in this report has already been covered as we've gone along. So the value of the fund's assets at the end of September was 3.4 billion. That's down from 3.7 at the beginning of the financial year, and just under 2/3 of those assets are now under the management of Brunel. Most of our allocations to most asset classes are now at or near target, including our private market assets. Although the caveat to that is that some of that is a function, if you like, of the downward pressure on markets, and certainly listed markets. The pension funds actuary Barnett Waddingham undertake a full assessment of the funding position every 3 years. They're in the process of finalising that at latest one of those as at March 2022, and the final report will be available in January or February of 23. But the key messages are broadly unchanged from when the committee had a training session with Barnett Waddingham in September. So the funding level is increasing from 92% at the last triennial valuation, March 2019, to 96%. The discount rate is down from 5% to 4.9%, and overall employer contribution rates are expected to be unchanged, but there will be increases in the primary rate broadly offset by decreases in deficit contributions. But important point to stress is that will vary between employers, and employers have been meeting with the actuary in recent weeks to discuss the results of the valuation. Just picking up a point that I think Steve mentioned about regular updates on the funding position, we have for the last probably 4 or 5 years asked Barnett Waddingham to give us an indicative update on the valuation position at the end of each quarter. I think that's something that we may need to review and revisit at the committee as to whether we ask them to continue to do that, because I think through the last cycle, the message from those quarterly reviews was actually the funding position was looking as though it could come in at less than what it was at March 2019. And then once they did the full exercise, we actually saw a pleasant surprise, but a surprise nonetheless, that the valuation had actually improved. And one of I think a major reason for that you'll recall from the training is changes in demographics that had helped that as much as investment performance. So I think it may be something that we might need to come back to see, is there a value in having these quarterly updates from the actuary.
Do we have to pay for it?
Yes. We generally have to pay for anything with Barnett Waddingham.
Yeah,
so unfortunately, I don't know how much. So again, that might be a factor to take into consideration. But in the grand scheme of things, relatively small amounts. We've also talked earlier about the performance of the investments over the period. So I'm not going to repeat those. And we've also talked about what the main detractors to performance have been in the quarter and the year to date, which have been many of the Brunel active portfolios we're invested in. The exceptions to that are the unhedged smart beta portfolio that we're in, and Brunel's private equity portfolio as well, which has done well. The report sets out, I suppose the caveat to that is that valuations in private markets tend to be lagged in terms of public markets. So whilst we hope that maybe we're approaching the lower point in terms of public markets, in terms of valuations, there's probably a likelihood that we may not have seen the bottom in terms of private market valuations because of that lag. The performance of individual asset class managers is set out in the report, and we mentioned the performance of Royal London. The one thing I just would add about Royal London is that, and I think this probably echoes Steve's comments about them being a good manager, in that over most time periods, or if not all time periods, they have outperformed their benchmark. So they have done, in difficult circumstances, they have outperformed their benchmark. I think that's all I wanted to say, Chairman, but happy to do my best to try and answer any questions. Thank you. Thank you, Chairman. So this is an annual requirement, as you probably guessed, under the Local Government Pension Scheme regulations, require us to all administering authorities to publish an annual report on the activities of the funds. And this is the report for the end of March 2022, which is written in accordance with the most recent SIP for guidance. That does mean that it's quite a hefty document. I think it's in the region of about 150 pages. The plus side is that it is one source for everything. Everything perhaps you might want to know about the pension fund is contained in one document. I think as the report says, and as coming back to Ian House's opening sort of comments at the top of the agenda, we've not yet received the auditor's report for 2021-22, and as Ian said, we've not actually had the final report for 2021 either. So the annual report is in draft status until we actually have that final statement from the auditor. And when we do receive those reports from the auditor, we will of course circulate them to members of the committee as soon as we can. So today really what we're asking for is approval to publish the annual report in its draft unaudited format. But again, happy to take any comments or questions that members may have. Keep going. So, sorry, you should do that.
So then on to the proposed dates for future meetings. Is there a recommendation? Oh, sorry. Yes, you're quite right. Yes, we need approval to. We need a move in a second, presumably. So as Roberts moved and Adrian seconded. Because all those in favour of approving publication. Anyone against? No, it's a unanimous decision to approve publication. Thank you very much. Right, then on to the dates for future meetings. The only one we've currently got scheduled is for the 14th of March. I presume that it was just in doing a training day related to this as well, judging by the need for more training.
Yeah, thank you, Chairman. I think we'll circulate something, but I think we're likely to propose Monday the 13th of March as a training day. But we'll circulate that, a note round to committee members. Just going on to meetings for 23-24, the calendar of meetings for Dorset Council, I understand, is approved by full council in January 23. But what we can do is circulate the proposed dates to members, so you've got early sight of those dates.
Yes, thank you. It's important, particularly to make sure obviously the BCP members are aware of what the dates are, so they can check with their own authority, just to make sure that there aren't any clashes. Okay. In which case, that's the end of the public business. I need somebody to move to go into exempt business. Will somebody move that, please? Thank you. So can we turn off the recording then, please? Sure.